When people look at today's economy, they see record stock prices, artificial intelligence breakthroughs, and politicians promising stability. But empires never announce their collapse. They whisper it through cracks in their foundations. And those cracks are widening fast. The national debt has surged past $38 trillion. Inflation refuses to stay tamed, and the markets have become addicted to an illusion of prosperity built on borrowed time. Every empire in history, Rome, Spain, France, Britain, believed it could outsmart gravity. They all fell the same way, slowly at first, then all at once. What's happening now isn't a future threat, it's the present reality. The United States has entered the same mathematical trap that ended every empire before it. More debt than growth, more confidence than substance, and more belief than balance. The numbers no longer add up, and confidence is the only thing keeping the machine alive. But confidence is fragile, and once it breaks, everything that depends on it collapses. The next global economic crash won't begin with panic. It will begin with silence. The quiet normalization of impossible numbers. By the time most people realize what's happening, the system will already be unraveling. The question isn't if this collapse happens, it's how deep it goes, and who's ready when it does. The end of an empire never begins with war. It begins with math. Numbers don't scream. They whisper warnings that most people ignore until it's too late. And right now, the numbers defining the U.S. economy are sounding the loudest alarm in modern history. The United States national debt has blown past $38 trillion, the highest in recorded history. To put that in perspective, that's about $111,000 of debt for every man, woman, and child in the country. Worse, the pace is accelerating. It took the United States over 200 years to accumulate its first trillion in debt, and just 2 months to add the most recent one. That's not growth. That's decay wearing makeup. Every empire in decline follows this same mathematical pattern. Debt grows faster than income. Interest grows faster than tax revenue. And, eventually, the act of paying interest itself consumes the empire's ability to survive. The U.S. government now spends over $1 trillion per year just on interest payments, roughly 17% of all federal spending. That's money that doesn't build infrastructure, educate children, or strengthen the military. It's tribute, a payment to the past for the privilege of pretending the future still exists. And the projections are catastrophic. Within a decade, those interest payments will reach $14 trillion, meaning America will spend more servicing old debt than funding everything else combined. This isn't fiscal management, it's financial cannibalism, a system devouring itself to stay alive. But debt isn't the only warning sign. The stock market, which once reflected business reality, now floats in a parallel universe detached from logic. The total value of U.S. equities has surged to 363% of GDP, higher than at any point in American history. During the dot-com bubble of 2000, stocks peaked at 212% of GDP, and we all remember what followed. Today's valuation makes that mania look conservative, and the distortion doesn't end there. Artificial intelligence stocks now account for 75% of market returns, 80% of earnings growth, and 90% of capital investment. The entire market has become a bet on a handful of companies, each valued not by performance, but by belief. Some AI startups trade at thousands of times their annual revenue, while the average price-to-sales ratio across AI firms sits near 25, far beyond the 18 that defined the dot-com frenzy. This isn't a market, it's a mass hallucination priced in trillions. And like all bubbles, it's sustained not by profits, but by faith. Meanwhile, the real economy underneath the glittering charts tells a very different story. Consumer spending, which drives 70% of U.S. GDP, is slowing sharply. Major banks are reporting that growth in spending has been cut in half compared to last year. People aren't buying because they feel secure, they're buying because they're afraid of what happens if they stop. Savings are collapsing, debt is exploding, and confidence is hanging by a thread. This is what collapse looks like before it becomes visible. It's not a sudden crash. It's a slow arithmetic poisoning. A system where debt feeds on debt, where speculation replaces productivity, and where mathematics, silent and merciless, waits for its revenge. Because math doesn't negotiate, it doesn't care about optimism or politics, and once the numbers stop adding up, the empire stops standing. If you only looked at the headlines, you'd think we were living in a golden age. Record stock prices, low unemployment, technological breakthroughs, the perfect picture of progress. But beneath that glossy surface lies an economy held together by debt, denial, and delusion. The so-called boom isn't prosperity, it's pressure, building quietly before the break. Consumer spending, the lifeblood of the American economy, tells the truth no one wants to face. It accounts for nearly 70% of GDP, yet it's slowing fast. Bank of America, which tracks over 60 million customer accounts, reports that spending growth has fallen by half compared to last year. Americans are still spending, but not because they can afford to. They're using credit cards to postpone reality. Household debt has reached record levels, with credit card balances now exceeding $1.3 trillion for the first time in history. And that's before factoring in car loans, student loans, and mortgages stretched to their absolute limits. Meanwhile, savings have vanished. The average American household has less than $5,000 in savings, and for millions, even a minor financial shock could mean disaster. The pandemic-era stimulus money that once padded checking accounts has long been spent, leaving only fragile optimism in its place. That optimism, like every bubble before it, is built on the illusion that tomorrow will always look like today. But history and mathematics say otherwise. The cracks are showing everywhere. The Bureau of Labor Statistics quietly revised its employment numbers downward by 258,000 jobs, revealing that the job market wasn't growing, it was shrinking. Unemployment has crept up to 4.2%, and the so-called resilience of the labor market is beginning to unravel. Wages are stagnating even as the cost of living climbs, and the people who once fueled America's spending engine are running on fumes. But perhaps the biggest illusion of all is the stock market, where the loudest voices celebrate record highs as proof of strength. In truth, that strength is dangerously concentrated. Artificial intelligence stocks have become the new religion of Wall Street. Since the AI revolution began, they've driven 75% of all market returns, 80% of earnings growth, and nearly 90% of capital spending. The result is an economy balanced on the shoulders of a handful of companies, and a technology that's still in its infancy. These valuations aren't just high, they're historic. The median price-to-sales ratio of AI-focused companies now sits at 25, surpassing even the dot-com peak of 18. Startups are being valued at thousands of times their annual revenue, and investors talk about disruption as if it's a substitute for profit. The last time investors believed that story, the market erased $7 trillion in wealth. But this time, the stakes are even higher. Unlike 2000, today's economy is globalized, digital, and algorithmic. The same optimism that drives AI stocks fuels pension funds, real estate, and even national budgets. When the correction comes, and it won't stop at Silicon Valley. It will spread through the entire financial bloodstream. Behind the hype, the real economy is gasping for air. Manufacturing output has declined for months. Commercial real estate vacancies in cities like San Francisco and New York are at their highest since the 2008 crisis. Small businesses, the true employers of America, are closing at alarming rates as interest rates crush their margins. These are not isolated data points. They're vital signs of a system in decline. And yet, the illusion persists. The media calls it resilient growth. Politicians call it a soft landing. But to anyone who understands history, it looks more like the quiet calm before the earthquake. Every empire creates stories to convince itself it's immortal. And America's story today is that technology and credit can replace productivity and discipline. But prosperity built on speculation is not prosperity. It's performance. It's theater, a collective act of belief designed to delay panic just long enough for insiders to escape. The truth is simple and devastating. America's economic miracle is a mirage. It shimmers with hope from a distance. But up close, it's built on sand. Beneath the data, beneath the noise, one fact remains unchangeable. You can't borrow your way to wealth. And as the tide of confidence begins to recede, the illusion of endless prosperity will disappear with it. When that happens, the story changes. The age of denial ends, and the reckoning begins. Every empire in history reaches a point where belief replaces discipline. Spain believed its silver fleets would fund eternity. France believed revolutions could be financed forever. Britain believed its colonies guaranteed solvency. And now, America believes the dollar makes it immune to consequence. But history doesn't bend for pride. It crushes it. The United States Federal Reserve stands at the center of an impossible paradox. To fight inflation, it must raise interest rates, but higher rates make the national debt unsustainable. To ease that burden, it must lower rates, but that reignites inflation. Either choice leads to collapse. This is the trap that every overextended empire eventually falls into, the point where mathematics, politics, and psychology collide. For decades, the Federal Reserve claimed control over the economy, assuring the public that recessions could be prevented and crises could be managed. But their illusion of control was bought with printed money. Since 2008, the Fed's balance sheet has exploded from under $1 trillion to over $8 trillion. That flood of artificial liquidity distorted every signal in the market. It made bad businesses look good, inflated asset prices beyond reason, and created a generation of investors who mistake speculation for skill. Now, as inflation refuses to vanish, the central bank is cornered. Consumer prices are still rising around 3% annually, and gasoline jumped 4.1% in a single month. The 2% inflation target that once seemed achievable now looks like a fantasy. If the Fed tightens further, it risks detonating the debt bomb buried beneath the U.S. economy. If it loosens, it destroys the dollar's credibility. Both outcomes lead to the same destination, collapse, only by different roads. The deeper tragedy is that this trap is self-inflicted. America spent decades teaching the world that growth matters more than balance, and confidence matters more than cash flow. Politicians learned that they could win elections by promising prosperity funded with tomorrow's money. Corporations learned that debt was cheaper than discipline, and citizens learned that rising stock portfolios meant they were rich, even if their savings accounts were empty. But when everything is built on borrowed confidence, all it takes is one crack for the illusion to collapse. And those cracks are already spreading across the world. Countries once dependent on the dollar's dominance are quietly building escape routes. China, Russia, India, and even longtime U.S. allies like Saudi Arabia are experimenting with trade settlements outside the SWIFT system. Central banks around the globe are buying gold at the fastest pace in half a century, a clear vote of no confidence in fiat currency. The rest of the world sees what America refuses to admit. The empire's foundation is built on credit, not production. And yet, inside the United States, denial reigns supreme. Politicians insist that debt doesn't matter. Economists claim that deficits are self-financing, and the media preaches the gospel of soft landings. It's the same arrogance that echoed through history before every fall. The Roman Empire devalued its currency until its coins were worthless. The Spanish Empire drowned in silver it couldn't spend fast enough. The French monarchy financed its own revolution. Every great power believes its era will last forever, right up until the moment it doesn't. What makes the modern empire's trap so lethal is its global reach. The US dollar isn't just America's currency, it's the backbone of the world's financial system. When that foundation weakens, everything built upon it shakes. As faith in the dollar erodes, the ripple effects will reach every nation that holds US debt, every market priced in dollars, and every bank that depends on dollar liquidity. In other words, when America catches fire, the world burns with it. And yet, there's no easy escape. The empire can't stop borrowing, can't stop spending, and can't stop pretending. To do so would be political suicide. But to continue guarantees economic extinction. This is what history calls the point of no return, the moment when the empire must choose between short-term survival and long-term collapse. Most choose survival, and in doing so, seal their fate. America's empire of debt is no different. When a nation reaches the stage where it borrows to pay interest on old loans, when it prints money to hide insolvency, and when it measures success by how long it can postpone the inevitable, its fate is no longer in question. Only the timing remains. When an empire built on leverage begins to shake, the damage doesn't stay contained. In a globalized world, money moves faster than understanding. What begins as a tremor in one corner of the system can trigger a cascade across continents. The modern economy is no longer a series of independent nations. It's a single, tightly wound domino chain, where one fall brings down them all. One of the most fragile pieces in that chain is something few people outside of finance even know exists. The Japanese yen carry trade. For decades, investors have borrowed cheap yen from Japan, where interest rates hovered near zero, and used that money to buy higher-yielding assets around the world. Stocks, bonds, real estate, even emerging market debt, all financed with near-free Japanese credit. It worked as long as two conditions held true. Japanese rates stayed low, and global markets stayed calm. But when either changes, the entire machine reverses, and violently. That reversal has already begun. When the Bank of Japan raised rates slightly, markets across the world convulsed. The volatility index, VIX, spiked to pandemic-era levels within hours. Global equities tumbled. Algorithms triggered automated sell orders, compounding losses in seconds. What should have been a minor policy move turned into a global panic, forcing emergency responses from central banks. That was just the preview. The real danger isn't the yen itself, it's what it represents, a web of hidden leverage. The total exposure of these trades, when counting Japanese institutions and global funds, is estimated at nearly $20 trillion, an amount roughly equal to the entire U.S. economy. If those positions start to unwind simultaneously, there won't be enough liquidity in the world to absorb the shock. The sell-off won't stop at one market. It will spread to commodities, currencies, bonds, and equities, creating a synchronized collapse across asset classes. But Japan isn't the only domino trembling. Commercial real estate across the West is imploding under the weight of remote work and rising interest rates. Office buildings in New York, San Francisco, and London are now worth less than their mortgages. Many will default. When those loans fail, the pain won't stop at property developers. It will hit the banks, pension funds, and insurance companies holding the debt. And because those institutions are interconnected, one default triggers another, like fault lines breaking beneath the surface. The same fragility exists in the corporate sector. For more than a decade, companies that should have gone bankrupt were kept alive by cheap credit. Economists call them zombie companies, businesses that can only afford to pay the interest on their loans, not the principal. Now that interest rates have returned to reality, those zombies are dying all at once. Corporate bankruptcies are up over 40% year on year, and the ripple effects are enormous. Every company that fails drags down suppliers, creditors, and investors, spreading contagion through the entire supply chain. And just when you think the human element might slow things down, technology accelerates it. Algorithmic trading systems, operating at microsecond speeds, will amplify panic when the first shock hits. These systems don't think, they react. When one asset crashes, they sell everything correlated to it. A fall in real estate prices triggers a sell-off in bank stocks. A drop in tech earnings tanks commodities. The result is automated contagion, panic at the speed of light. Meanwhile, central banks, the supposed guardians of stability, are nearly out of ammunition. Interest rates are already historically low in most developed economies. Their balance sheets are bloated from years of money printing. If they print more, inflation reignites. If they don't, markets collapse. It's the ultimate lose-lose scenario. Governments will respond, but their solutions will make things worse. Trade wars, currency devaluations, and protectionist policies that fracture the global economy even further. The contagion won't stop at finance. It will bleed into politics, society, and daily life. Unemployment will rise as over-leveraged companies cut costs or collapse. Pension funds will shrink as market losses compound. The social fabric will strain under the weight of fear, anger, and disillusionment. Every economic downturn in history has been followed by political upheaval, and this one will be no different. This is what makes the coming collapse unlike anything before. The 2008 financial crisis was contained by central bank coordination and government bailouts. The next one will be global, digital, and simultaneous. There are no firewalls anymore. Markets, nations, and algorithms are all connected, pulsing together like a single nervous system. And when the shock finally hits, it won't unfold over months. It will unfold in minutes. Because in the domino system we've built, collapse doesn't happen step by step. It happens all at once. When a system this large finally breaks, it won't be gradual. It will be violent. The crash won't look like 1929, with men in suits lining up outside banks. It will happen in seconds, on screens, through algorithms, and across oceans. A digital panic that moves faster than human thought. Bank runs will no longer involve crowds. They'll be electronic, with billions withdrawn in minutes. The FDIC, with its limited reserves, will discover that deposit insurance means nothing when withdrawals are instant. Pension funds will disintegrate as algorithms liquidate their holdings to cover margin calls. Shadow banks, hedge funds, private equity firms, and unregulated financial institutions will implode, revealing how much of the financial world was nothing more than smoke, leverage, and faith. The collapse of confidence will feel like gravity returning after years of weightlessness. For decades, Americans felt rich because their homes and portfolios said they were. That illusion, the wealth effect, drove an entire era of consumption. But when markets fall, that confidence evaporates. Home values plummet, retirement accounts shrink, and the psychological fallout begins. People who felt secure will suddenly feel poor. And when enough people feel poor, spending stops. Businesses close, jobs disappear. The cycle feeds itself until even the most resilient institutions buckle. Governments will scramble to respond, but every lever they pull will tighten the noose. Austerity will crush growth. Stimulus will ignite inflation. The political divide will explode as one side blames the greedy rich and the other blames incompetent leaders. Social unrest will follow. This is not speculation. It's historical pattern. Every empire's economic collapse has been mirrored by its social one. And yet, in the ashes of every collapse, something remarkable always happens. Renewal. When the illusion burns away, reality returns. The Great Depression birthed modern finance, social safety nets. The 2008 crisis gave rise to the decentralized systems, digital currencies, and a new awareness of financial fragility. The coming collapse, the one unfolding right now, will do the same. It will strip away speculation and force the world back to fundamentals, production, value, and sustainability. The next age won't be defined by leverage, but by discipline, by companies that actually create, not just inflate, by nations that build wealth through innovation and industry, not through printing and promises. It will be painful, yes. Collapses always are, but pain is not destruction, it's correction. The 2026 collapse will likely mark the end of an era built on debt and denial, but also the birth of one built on resilience and realism. For individuals who prepare, this won't be the end, it will be a reset, the chance to rebuild portfolios around real assets, land, energy, commodities, and productive enterprises that survive when illusions fail. For societies, it's an opportunity to remember that prosperity must be earned, not borrowed. Every collapse in history has been both a tragedy and a turning point. It wipes away excess but leaves behind clarity. The world that emerges from the coming breakdown will look smaller, simpler, and harder, but more honest. Wealth will return to those who create real value. Power will return to those who understand limits. And as the dust settles, those who saw this coming won't be asking how it happened. They'll be asking what comes next. Because history doesn't end with collapse. It begins again. And this time, maybe, the world will remember that you can't build forever on promises written in debt. Every empire believes it's different, that it can outsmart history, bend mathematics, and postpone reality forever. But history always wins. It has no mercy, no bias, and no exceptions. It only asks one question. How long can you ignore the truth before it breaks you? The truth is that the collapse has already begun. You can see it in the grocery aisles, in the shrinking paycheck, in the rising rent. You can feel it in the quiet anxiety of people who no longer trust the system but don't yet understand why. What's unraveling now isn't just an economy, it's a mindset. The belief that debt equals prosperity, that speculation equals innovation, that illusion equals stability. But this is not the end of the world. It's the end of an illusion. What comes next will be brutal, but also cleansing. The system will correct, just as it always has. The weak will fall, the strong will adapt, and those who understand what's happening will rebuild from the wreckage. Every collapse creates a new beginning, and this one will be no different. For those who are awake, for those who see through the noise, this isn't a moment to despair. It's a moment to prepare. Because when the dust settles, there will be two kinds of people left. Those who lost everything waiting for things to go back to normal, and those who built the next normal while the world was burning. The greatest economic collapse of our lifetime isn't coming. It's already here. The only question that matters now is, what will you do about it?